Hey everyone, welcome back to The Explainer. Today, we're putting on our analyst hats and taking a hard, incredibly objective look at Shoals Technologies. We are going to completely unpack their recent and honestly, highly debated Q1 2026 earnings report. Whether you're tracking the solar sector every single day, or you just love a really fascinating financial case study, there is a whole lot to dig into here.
Let's just jump right in with an absolutely massive number, $140.6 million. That is Shoals' total revenue for Q1 2026. And get this, it represents a nearly 75% jump year over year. I mean, in any industry, pulling off a 75% top-line growth is just phenomenal. It's the kind of number that immediately demands your attention.
But, well, here is exactly where the story gets a little messy. Despite that record-breaking surge in revenue, the company actually ended up posting a $300,000 net loss in that very same quarter.
So how in the world does that happen? Here's our roadmap to figure out this financial mystery. First, we'll look at the Q1 earnings paradox. Then, we'll go inside Shoals Technologies. Third, we'll check out their balance sheet and backlog. Fourth, we'll break down the bull versus bear debate. And finally, the verdict.
Okay, starting off with part 1, the Q1 earnings paradox, record demand versus missing profits. So look at these two stark realities. On one hand, Shoals has an unbelievable $758 million sitting right there in record backlog and awarded orders. The demand is totally undeniable. But then, for Q1 2026, their basic earnings per share sat absolutely flat at $0. Think about that. How does a company with so much guaranteed, locked-in future demand fail to turn a basic per share profit today? Well, to answer that, we really need to understand what it is they actually do. Which brings us to part 2, inside Shoals Technologies, or what we can think of as the nervous system of solar.
You see, Shoals isn't out there manufacturing the solar panels themselves. Instead, they provide what's called the electrical balance of systems, or EBOS. Imagine EBOS as this absolutely critical physical infrastructure, the literal nervous system that safely and efficiently wires millions of utility-scale solar panels together and connects them directly into the power grid.
And you know, they aren't some flashy new startup hoping to strike it rich overnight in green tech. They were actually founded back in 1996 as an automotive supplier before they successfully pivoted to solar EBOS in 2002. Today, they've got over 70 gigawatts under contract or operating globally. They're a seasoned, award-winning market leader, and they're even expanding their U.S. manufacturing footprint down in Tennessee right now.
But their real secret weapon isn't just selling wires. It's pure efficiency. Their harnessing systems are highly standardized. They're plug-and-play. This drastically cuts down the time needed to build out a massive solar farm. And maybe more importantly, it hugely reduces the need to hire incredibly specialized, expensive electrical labor out in the field. So at the end of the day, they are selling efficiency and cost savings to developers.
Let's look past the surface level in part 3, balance sheet and backlog. We're looking for the momentum beneath the surface.
Look, whenever an analyst sees a company post a loss, the very first place they dig into is the debt. Right now, Shoals sits at a 1.3x net debt to adjusted EBITDA ratio. And honestly, that 1.3x is a fantastic metric. It tells us that their debt is highly manageable, and they've got strong, healthy liquidity. They're certainly not drowning in leverage.
And then we have this visual right here. Just look at that steady, almost staircase-like climb of their backlog and awarded orders. It literally just keeps going up. This acts as a massive financial safety net of guaranteed future work, giving the management team incredible visibility into what's coming down the pipeline.
If you want to put a solid number to all that demand, Shoals reported a book-to-bill ratio of 1.2. Let's translate that from finance jargon for a second. Anything over a 1.0 is exactly what you want to see. A 1.2 basically means that for every single dollar of product they are shipping out and billing for, they're simultaneously booking $1.20 in brand new orders. They are literally pulling in business 20% faster than they can push it out the factory doors.
All right, moving to part 4, the bull versus bear debate. The million-dollar question here is whether their margin narrative is actually sustainable.
So analysts are pretty fiercely divided on this one. On the bull side, optimists are quick to point out that trailing 12-month earnings are actually up over 39%, and net margins have improved to 7.1%. Plus, they argue that the Q1 loss was heavily skewed by a $16.5 million one-off expense. But bears aren't buying it. They point out that dropping to a loss ruins a solid streak of profitable quarters.
Worse, expected forward revenue growth is at 7%, which is really dragging behind the broader market forecast of 11.2%. And to top it off, the stock is currently trading at a premium valuation compared to its peers.
So for the bulls, it's all about zooming out. They point straight to that 7.1% trailing net margin. They're basically saying, look, if you stop staring at one tricky quarter and look at the whole 12-month window, the company actually earned $33.6 million in net income. The big takeaway for them is that the core economic engine of Shoals is absolutely working, even if quarterly costs are a little bit bumpy from time to time.
But man, here is what is keeping the bears tossing and turning at night. The market expects Shoals' earnings to grow at almost 22% annually, but revenue is only expected to grow at 7%. This totally illustrates the biggest risk here. For earnings to grow 3 times faster than revenue, Shoals absolutely has to achieve near-perfect operational efficiency. They need continuous margin expansion. If their costs rise even a little bit, that earnings target completely shatters.
Which brings us to part 5, the final verdict. Let's pull all these threads together.
So here's your high-level takeaway from today's explainer. Shoals is undoubtedly a dominant market player. They've got a highly defensible balance sheet and record-shattering demand approaching $760 million. Those are incredible, undeniable strengths, but the risks are very real too. The stock is essentially priced for perfection, top-line growth is forecasted to lag the broader industry, and their future success relies incredibly heavily on squeezing out more profit from every single dollar they sell. The number one catalyst you need to watch is their next earnings report. Is Q1 just a one-time blip or the start of a really concerning trend of heavier costs?
And that leaves us with this final, incredibly provocative question to think about for your own portfolio. When you weigh that massive backlog against this sudden margin pressure, is Shoals' Q1 loss merely a temporary speed bump, or are we looking at the very first crack in their premium growth narrative? I really hope this breakdown gave you the clarity you need to explore that question further. Thanks so much for learning with me today, and I'll see you on the next explainer.